Welcome to the second video of the course module devoted to formulating financial strategies. In this video, we will explore the concept of an optimum capital structure, which is without doubt one of the key elements of a company's financial strategy. The goal of this video is to acquaint you with the basic concepts related to the choice of a company's sources of financing, which will be further expanded on in further modules of the course. As you already know, raising finance and minimizing the cost of a company's capital are among the key roles of a corporate financial manager. A company's financial strategy has to allow the business to finance its existing and planned investments using an optimum mix of the two main sources of finance, that is equity and debt. From the perspective of generating company value, the optimization of capital structure is one of the key factors which impact shareholder wealth. Probably the most important issue associated with corporate financing is a company's level of gearing, a factor which enables the organization to lower its cost of capital. You should appreciate that the choice of a specific capital structure in a company is tied to the inherent trade-off between the advantages of debt, which is usually the cheaper form of financing, and the risks associated with a high level of gearing. From this perspective, finding the optimal proportions of debt and equity to be employed allows the company to minimize its overall cost of capital and thus maximize company value. Let us now consider how gearing impacts a company's cost of capital. The overall cost of capital is the average cost of all sources of finance used, which include both equity and debt. However, there is a major difference between debt and equity as sources of finance. As you know, shareholders assume the overall business risk associated with a company's operations and only receive variable remuneration in the form of dividends when the company is generating profits. On the other hand, a company's lenders or holders of its debt instruments are promised a fixed or determinable level of remuneration in the form of interest, which the company must pay regardless of profitability. Given the higher level of risk taken on by equity holders, the rate of return expected or required by providers of equity financing should be higher than the rate required by debt holders. As a result, debt is typically considered a cheaper form of financing than equity. The difference between the cost associated with debt and equity financing is also associated with yet another important consideration, namely that the return available to shareholders is subject to corporate income tax, whereas the remuneration paid out to debt holders in the form of interest typically constitutes a tax-deductible expense. Therefore, gearing allows a company to enjoy the benefits of a tax shield, which has the effect of further reducing its average cost of capital. On the other hand, however, financing by debt implies that the company assumes an obligation to pay interest to its lenders, regardless of financial condition, which obviously increases the overall riskiness of the business. This is due to the fact that the more indebted a company, the higher the portion of its revenue needed to cover interest payable, leaving the company with less flexibility in the case of worse than expected performance and leaving shareholders with even less hope for profit, which could be distributed to them in the form of dividend payments. As a result, when gearing is particularly high, shareholders require a premium, an additional return to cover the increased risk which they bear. As you can see, gearing has the potential to affect a company's average cost of capital in a twofold way. Until it reaches a certain level, debt can help lower the cost of capital due to its lower cost and associated tax shield effect. Beyond that point, however, gearing will increase the average cost of capital due to the increasing risks associated with the company becoming overly indebted. As you may expect, there is no simple method of finding that optimum point. There are a number of theories addressing this issue: the Modigliani-Miller theory, static trade-off theory, or the so-called pecking order theory. We will be exploring them in further modules of the course. There are a number of practical issues which companies consider when formulating a strategy with respect to debt financing. Let's take a look at them now. The first issue relates to the availability and cost of debt. The market for debt, both for loans and bonds, is subject to fluctuations. There are periods in the economic cycle when banks are less willing to grant loans to companies and potential investors less inclined to purchase bonds. In addition, the more a company is leveraged, the more expensive it may be to issue additional debt. This is obviously due to the fact that lenders perceive such companies as more risky and thus demand a higher return on fresh debt offered, via increased interest margins levied by banks and higher yields required by bondholders. Another aspect of debt financing associated with the cost side of borrowing is the impact that debt has on the overall level of costs incurred by a company. This relates primarily to the ongoing interest cost, but also the cost of issuing debt, which may become significant, although it is typically lower than the cost of issuing new shares. Speaking of interest, we should also note that company value may be exposed to the risk of adverse changes when the debt issued is a floating rate instrument. In such cases, rising rates of interest in the market will increase the level of interest paid by the company. In order to manage this risk, companies typically hedge the exposure to variability of interest payable by fixing its level, for example using interest rate swaps. It should also be mentioned that debt financing is usually more accessible to well-established companies which generate stable revenues sufficient to service debt obligations. Consequently, issuing debt is generally seldom an option considered by startups. The optimum financing strategy for a company is also connected with the tax regime of the jurisdiction where the company operates, as this clearly impacts the value of the tax shield from which it may benefit. With tax considerations being among the main drivers of debt financing, the higher the tax rate in a given jurisdiction, the higher the tax shield benefits that may be achieved as a result of taking on debt. Finally, we should not forget that issuing new debt requires convincing shareholders that increasing the leverage of a company will generate additional value to them, in particular when a company's articles of association contain restrictions regarding the level of gearing allowed. Similar restrictions, referred to as credit covenants, may also be included in debt agreements already in place. As you can see, achieving the optimum capital mix is a crucial element of a company's financial strategy through which the cost of capital may be minimized and shareholder value created. We will be exploring the topic of cost of capital as well as the various theories of capital structure in further modules of the course.